Hello, I'm Michael Hainsworth. The Bank of Canada is keeping its powder dry. Do you still believe we're on hold for the rest of the year?
I don't think we can say that. I think there's too much uncertainty. I think we're on hold because it's a wait and see time for the Canadian economy. You know, you do have to start raising rates to bring overall inflation down, or else the expectations of Canadians get kind of what we call de-anchored from the 2% target. And then, you know, the kinds of decisions that get made in an economy get worse from there.
That's the C.D. Howe Institute's Center of Financial and Monetary Policy head, Jeremy Kronick. He, alongside Steve Ambler, the David Dodge Chair in Monetary Policy, have watched as the central bank holds the key interest rate at 2.25%. And the Americans haven't moved for the first time since July. The central bank is predicting 1.1% growth this year for Canada. The Institute is predicting no change at the overnight lending rate all year. Jeremy and Steve join us now. Thank you for joining us.
Thanks for having me.
Thank you. Good to be with you.
So let's, right out of the gate, Jeremy, the Bank of Canada Governor Tiff Macklem says the review of CUSMA is an important risk to his outlook. Has it changed yours?
No, I think it's the same the same risk it's always been. I mean, Canada is heavily reliant on trade to the U.S. We're looking to diversify, but diversification takes time. And in the meantime, CUSMA has largely helped us, help the economy be more resilient for the last year and a bit. Effectively 90% of our goods fall under CUSMA. And so there's obviously areas of concern in automobiles, for example, but for the most part, our goods have avoided the tariffs that really would have hurt. And so if that agreement is at risk, which it seemingly is, that is going to be a potential big concern for the economy and therefore monetary policy.
And what, Steve, do you see as the big risks to the outlook?
Oh, that's the elephant in the room, so to speak. I mean, I think Canadian governments have been talking for decades about how it would be a good idea to diversify some of our trade away from the U.S. But when you live right next door to your major trading partner and you share the longest undefended border in the world, and your next closest trading partner is, I guess, Greenland, it's difficult.
So then what is the canary in the economic coal mine for a change in rates? Is it employment?
For this particular announcement, right? And then if you think about what this means for the future, there's a lot of conflicting data, right? So on the one hand, you look at headline inflation, it's at 2.4%. That's an uptick. That's 4 straight months where it's been, a bit over target, and coming out of a period where we had as much inflation as we did, at levels we hadn't seen in many, many years, that's concerning for the central bank. But on the other hand, if you look at the data, both the GDP data, consumer spending data, the labor market data, there's a lot of signs of weakness, of underlying weakness that I think will into 2026. We mentioned CUSMA, and uncertainty for business is a killer, right? I mean, it prevents long-term kinds of investment, which is the kind of stuff that you need to have sustainable economic growth. So I don't know if I think of it as a canary in the coal mine. I just think there's this conflicting data, but I would tend to side on that weak data that we see in Q3 GDP and looks like for Q4 GDP, and those labor market concerns combined, I think kind of outweigh my concern over headline inflation. But I think they were right for now to keep the overnight rate where it is, which is at the bottom of the neutral rate range. I think that makes a lot of sense.
And the committee has largely sided with you on that. I think you only have one outlier that suggests that we might see interest rates fall even further in 2026. Help me understand what the feeling is, broadly speaking, within the Institute as to why we're going to be lower for longer.
As of the last announcement, things were actually starting to look a little bit better in terms of economic growth and employment, but the numbers turned a little bit weaker in the last 6 weeks. So, unemployment has ticked up from 6.6 to 6.8%. And growth is forecast to be generally pretty weak for the foreseeable future. The Governor Macklem talked about the fact that a lot of business investment has been on the sidelines due to this climate of uncertainty. And he says that as, perhaps if new infrastructure investment comes online or spending comes online, then Canadian businesses will be able to orient themselves more towards that, but they're just waiting around. Business investment has been very weak for a long time in Canada. That's hampering economic growth. It's hampering productivity growth. And I think we're, in terms of GDP per capita or labor output per worker, we're not much better now than we were 10 years ago.
And is there anything that you see over the coming year that gives you cause for optimism on the issues like productivity and that low growth? Or are we all just sitting on our hands waiting for further evidence that the Americans are going to get their trade act together and therefore corporate Canada can loosen the purse strings further?
No, I think there's a lot to still be optimistic about, right? I mean, I think the moves that we've made to reduce interprovincial trade barriers, it's still a little slower than I would like, but there has been, significant movement at the federal level between many of the provinces, but there's more to do there. But I do think that there is this momentum to it. We just have to continue to push pretty strongly on it. The major projects office and some of those major infrastructure projects, I think those are going to get off the ground, and that should be a boon. So I think there's things to be optimistic about. But diversification takes time, as I said off the top. And so there is going to be this uncertainty until we get a better sense, I think, of what's going to happen in the middle of the year with the CUSMA review. One extra point I want to make on the diversification. I know I said it's going to take time, but if I can put a positive spin on it, we live in a society now, in an economy where it's dominated by services, right? And so the advantages to trading goods when you're close to a partner are obvious, but if you're now a more services dominated economy, then there's capacity to diversify more easily. And so we'd have to find the right services, but we're experts. We have expertise in many different areas in the services sectors, and we should look to focus on some of those where we can more easily diversify to other countries.
Yeah, 2 of the 4 founding fathers of artificial intelligence are in Canada.
Correct.
Our international trading partners, aside from the U.S., are far away, but it is true that our internal trading partners are quite often right next door to each other. So this move towards a freer interprovincial trade is good. It's another thing that Canadian and provincial governments have been talking about for decades. And it seems maybe the ball is actually starting to get rolling at this point. So that is encouraging. Artificial intelligence, for the time being, I mean, there is a lot of investment going on, a lot of investment spending going on. I think a lot of it is south of the border. Some of it may happen eventually north of the border. So far, it hasn't really translated into tangible increases in productivity. People are saying that it will anytime soon. So for the time being, it's more a question of, a lot of spending is going into it, and we're waiting to see the effects of that spending.
Yeah, that definitely is an entire podcast conversation in and to itself. And maybe we'll get back to it a little bit later on in our time together as well. But before we do, I want to move from the corporate pocketbook to the consumer pocketbook. How much longer can the BOC ignore food price inflation? The cost of feeding ourselves is growing at the fastest pace of the G7 countries.
Yes, that's right. And in fact, Jeremy mentioned a while ago in the conversation that inflation ticked up in December compared to November. But food price increases are really, in terms of sheer arithmetic, are actually driving inflation being higher than target. If you strip out food price increases, inflation year over year was below target in December. And there's all sorts of different reasons for why food price increases are so bad, and it's very worrying for consumers. We can speak about. We can give you a list of reasons. There's been drought in Western Canada. In doing our op-ed in the Globe and Mail, I was reading up on this, and it turns out that cattle stocks in Canada are lower than they've been since the 1980s. And that actually drove up beef prices in December by almost 17%.
It's drought
And
related, if I understand
yeah,
correctly.
and of course, sort of persistent drought in Western Canada has affected not only cattle and beef prices, but also any agricultural commodity you can think of that comes out of the West.
When central bankers have to make the decision as to what to do with the overnight rate, they look at effects on the demand side and effects on the supply side, and they look on the supply side. I'll just focus on that because that's a lot of what we're talking about, the factors that are driving food prices. They have to make the decision as to whether what's happening, these kinds of shocks, as we call them, are temporary or are they more permanent? And if they're permanent, are they likely to be just a kind of one-time level effect, or are they going to continue to cause inflation to increase? Because the ones that are sort of temporary, or the ones that maybe are a one-time jump and that's it, well, you can look through those, right? They're not going to affect inflation over the long run. The stuff that will affect inflation over the long run, at some point, you do have to start raising rates to bring overall inflation down, or else the expectations of Canadians get kind of what we call de-anchored from the 2% target. And then the kinds of decisions that get made in economy get worse from there. And so that's the kind of stuff that we pointed out in the op-ed, is that could get trickier the longer that some of these factors go on for. And some of them are issues that are policy-based or regulatory-based. We talked about internal trade barriers as an example of things that drive up the prices of goods. Now, and sometimes they get worse over time, but they can be reversed. And so are there things that we can do on the policy front so that all of the burden doesn't necessarily lie on central banks that are not best equipped for dealing with these kinds of more permanent supply side shocks?
And what would you recommend as a key policy revision to help ease the pain at the checkout counter?
Well, so I mean, I just mentioned more can be done on the internal trade barriers, and I mean that would be that's an obvious one, right? I think some of the stuff, the drought should reverse itself. I don't think that's kind of, to me, a clear temporary kind of shock, but that's one on the regulatory side that would certainly help.
And so something like drought is something that the Bank of Canada can do absolutely nothing about as well. I think that what the Bank of Canada should be doing is making it a stronger part of their communications, saying that, in fact, arithmetically speaking, as I said, inflation is high because food prices are increasing rapidly. They should explain why. If they think, and I think you can make the case that a lot of the reasons are temporary. So that should dissipate over time, and also perhaps stress the fact that once you remove food price increases from the measure of inflation, that things are actually looking pretty good below target. Because the real danger is, consumers, Canadian consumers, I think consumers in the world in general, pay really close attention to two main things: food and gasoline. At least the gasoline prices have been doing pretty well recently, but if these food price increases get built into expectations of inflation, these things can be self-fulfilling to some extent, because they'll drive things like wage demands and so forth.
Stay ahead of Canada's latest policy moves with the C.D. Howe Institute's weekly newsletter. Sound economic insights, early event alerts, straight to your inbox. Subscribe free at cdhow.org.
So then there's a slight chance of a rate cut in April or June, and a greater chance of an increase by October if the overnight index swap markets are to be believed. What do you think is behind those bets?
The further you go out, the more uncertainty there is, and that could drive some and there's some inflationary concerns if tariffs, if the tariff threats are to be believed, and if something with CUSMA, goes against the way we hope it goes, that could lead to more inflation, and that could drive the sort of the increases as you look ahead. The decrease a little earlier on could be a sort of a way of getting ahead of the problem, but I'm not sure that it's clear exactly why you would see a cut in April and then a hike later on. I think it, like I said, it could reflect uncertainty about what's going to happen with CUSMA. It could reflect wanting to try and get ahead of the curve. I bet that the central bank will have to stimulate the economy in anticipation of what might happen there.
And you were talking about swap markets, Michael, but I think there was a direct question asked to the governor in the press conference about what did he think the chances were of an increase versus a decrease further down the line. And he said, well, to answer that question, you have to assign probabilities, and to assign those probabilities, you'd have to assign probabilities to things like whether the tariff situation will get resolved or get worse. And to quote from a very famous American economist from the first part of the 20th century, Frank Knight, we're not in a situation of risk at this point where you can actually assign probabilities. This is a situation of uncertainty, where trying to put a probability on different events is a fool's errand, basically.
At that press conference, Mr. Macklem also suggested the transition to the new trade environment could be smoother than expected. Jeremy, I know you like to lean towards glass half full. Is the glass half full in this case?
The glass is shaking.
Yeah. If you want to be the optimist about where trade can go and the ease with which you can diversify, again, you look to the fact that we're a services-based economy, and we have a lot of expertise in different services. I mean, you mentioned AI earlier. We haven't necessarily taken advantage of that, but that is something that we could do, and those kinds of services have nothing to do with geography, whereas geography is a big part of the old gravity models in trade, and why you end up trading more with one country or over another. A big part of it is geography. And so I think that's the reason to be, optimistic. And we're clearly the Prime Minister is thinking along those terms, different, traveling all over the world, setting up different agreements, trying to get middle powers to all think similarly. So that would be the optimist kind of view of where we could go. But there's obviously other factors and realities at play as well.
Then let's look at the glass half empty on the other side of things. That the governor had warned that financial conditions could tighten if volatility returns to the markets. And with the talk of, the AI bubble bursting, is that the volatility at which he's hinting, or do you think, Steve, that there's something else at play?
I think, the AI bubble bursting is a big concern, possibly. There's also the question of persistent and very high government spending deficits, both north of the border and south of the border. For the time being, it seems to be relatively easy for the Canadian federal government or the U.S. government to finance those deficits at reasonable rates of interest. But these are the kinds of things that sort of follow the rule of the Hemingway rule of going bankrupt, gradually at first and then suddenly. So there's always a risk that, if people suddenly lose confidence in the ability of the Canadian federal government or the U.S. government to sort of get its deficits and debt under control, then things could go south very quickly.
To Steve's point about government deficits and debt, I mean, all interest rates in an economy are typically priced off of government debt. That's sort of the lowest interest rate debt you can have. If those interest rates start to increase, the spread to the rest to debt in the rest of the economy is likely to increase. You're likely to see interest rate increases in other sectors of the economy. And in some ways, the fight in the U.S. between the political side and the Fed is to lower. The view of the administration is that if the Fed lowers rates, that will make it, make debt less expensive and make for everyone, for the government and for the rest of the economy. So that kind of independence fight is over that, that particular area of things. But the problem is that the Fed doesn't control, the rates in the rest of the economy. They control one rate, the overnight rate, and then all rates are priced off of that, but they can be moved around, right? I mean, the private sector determines where other interest rates lie, and other countries, in terms of their demand for government debt, determine where different interest rates lie. So it's not as simple as the administration in the U.S. makes it seem, but it's an important thing to understand in terms of what's driving, some of the fight for independence in the U.S.
And it's what makes central bank operational independence really important. We distinguish in our recent paper between goal independence, and I think we have a very good system in Canada where the bank and the government negotiate on the every 5 years, and it's coming up for renewal this year, on what should be the specific goals or and the monetary policy framework, and then it's up to the Bank of Canada to actually decide how to achieve those goals. And there's always a tension between, government, politicians in general have shorter time horizons. Sometimes they're concerned about the next election, getting reelected, and if they can convince central banks to lower interest rates, which helps in the short term, it can help out for consumers in terms of their mortgage renewals, and it helps, as I've intimated as well, can help out with financing debt and deficits, but it can also fuel inflation, and in the long run make things much worse.
This is Michael in editing, and this is an excellent opportunity to point out that Jeremy and Stephen have put together an important piece about the importance of central bank autonomy, titled "Don't Take It for Granted." It's not just an issue for America, it's something we need to be concerned about here at home as well. Please go to cdhow.org if you're interested in reading that. All right, let's get back into it. What does the decision by the Bank of Canada to hold interest rates at the current level, as well as its statement, tell us about the health of the Canadian economy going into CUSMA renegotiations?
I think what it says is that there's conflicting economic data. And with the overnight rate at 2.25%, which is the bottom end of the neutral rate range, you're still getting perhaps a little bit of stimulus to the economy, but not really a ton.
Yeah, there are several ways to measure whether monetary policy is expansionary or contractionary. But with the rate at 2.25% and inflation slightly above that, we're still looking at a negative real interest rate. So the Bank of Canada can be argued is still stimulating the Canadian economy.
Jeremy, do you still believe we're on hold for the rest of the year?
I don't think we can say that. I think there's too much uncertainty. I think we're on hold because it's a wait and see time for the Canadian economy.
What do you say to a Canadian who's feeling a pinch at the pumps and feeling a pinch when they go to pay for their groceries, that the Bank of Canada held the line on interest rates at 2.25%?
It's a big driver of headline inflation right now being above target, but it's not easy for the central bank to make a move in either direction. If you increase interest rates, you slow down demand, you slow down the economy, more jobs are lost. The flip side is you lower interest rates and that will stimulate prices further. So it's a conundrum for the Bank of Canada.
Yes, it's always a conundrum for the Bank of Canada. Every time they make a decision, it's a juggling act. There's good news that has come in and bad news that has come in, and they have to weigh the two in the balance. And I think they made the right decision today.
Gentlemen, I appreciate your time and insight. Thank you.
Thank you.
Thank you very much, Michael.
That's the C.D. Howe Institute's Director for Financial and Monetary Policy, Jeremy Kronick. Steve Ambler is a fellow in residence with the C.D. Howe and serves as the Institute's David Dodge Chair in Monetary Policy. I'm Michael Hainsworth. Thank you for joining us. And please hit the subscribe button on YouTube or wherever you get your podcasts. It really does help.